Welcome to Subramani. Uh, One of the toughest things is to keep saying no to business proposals which come your way. There, I feel you're better off thinking like a banker than like a investment banker, because every banker concentrates on will I get back the money, because he's not going to make any great upside. He is in fact going to lose his complete capital if it's a bad call. So every banker considers risk far better than an investment banker or broker or an investor, because an investor says, oh, I'll put money in 10 companies, 2 will do extremely well, 2 3 will do well, and 3 4 will go away. Now 3 4 will go away to me sounds like are you mad? Why would you put money thinking it is okay if it goes away? To me, losing money is far more difficult than not gaining money. I don't mind losing opportunities, but I would be like they say that if you have been burnt by hot milk, you would get, even when you get curd, you will keep blowing at it thinking that it is hot, right? So we are all in that category. I don't like taking risk, and I'm very scared of risk, so I'm very scared of losing money, and that has perhaps helped me in the last 43 years. I can't understand how people concentrate on return. Why do people look at return without looking at risk? To me, it does not make any sense. So I remember in the 1980s we used to deal with a bank, and the bank had one person in risk, and his name was Radhakrishnan. And he would routinely say no. So for us it was like going to Radha with a proposal and Radha saying no. So we had named him Radha Na Bole, because he would say no to everything. And this is from the famous Lata Mangeshkar song where she sings about Radha Na Bole. I mean, it's a famous song. So we used to call him Na Bole. And the greatest learning from him was to identify bad businesses. So if you think a business is wrong, or the promoter is wrong, or the promoter is too flashy, or the promoter is living beyond his means, or the promoter has some vices. I remember doing a 140-page due diligence on a promoter in which an investor based in Singapore had to invest 140 pages, including with whom is he roaming around, with whom is he sleeping, and everything, how much of detailing that they wanted. And I said hardly 3 groups in India, 3 4 groups in India where you can put your money, but other than that you will not be able to put your money. So much of due diligence on groups. Then you realize why this company, why this investor was so rich. He was richer than perhaps the Birlas at that point in time. I'm talking of maybe 2000 or even earlier than maybe 1990s. So much of an obsession about risk, so much of an obsession about knowing the quality of management. To me, both these things are the only thing which matters. Nothing else matters. Even a bad business cycle, if you have invested too much in advance, suppose you have invested too much of money today in cement, and cement margins are down because raw material prices are high, or whatever be the reason, I would still not mind if I know that the promoter is good. If the promoter is good, yes, you can get the cycle wrong. You can enter late, you can enter early, you could have stayed too long. All those mistakes you can make, but you can't make mistake in management. So whenever there is some poor quality management share offered to me, I just look away. To me, it doesn't matter. To me, I am very worried about another thing. I am worried about, say, in 1986 I invested in Murugappa Group, maybe in Sundaram Group, and I made money, right? So far so good. 14 plus 22 years, so 36 years. But I don't know how the next generation is going to behave. To me, that is risk. It's easy to say that the apple doesn't fall far from the tree, but what changes could be happening in that group, whether they are getting more greedy, whether they are getting into businesses which they don't understand, what will happen, I have no clue. Both these groups have stuck to the old traditional businesses, so there is nobody telling them, oh, you're too old, you don't understand technology. I don't know. I'm sure the younger people understand technology, but older people perhaps understand risk. And to me, understanding risk is far more important than calculating return. To me, I could never invest in a company which is making cash losses, saying, hoping one day it will make money in the future. For me, that was very difficult to accept. So it took me a long time. When Bharti was available at 80 rupees, I thought, oh my God, should I be investing? And I said, oh, I missed it at 30. So somebody said, no, but it's okay. At 300, you will say I missed it at 80. So to me, investing in Bharti, I don't think Bharti was paying dividends at that stage. And one of those people who still believe in the P/D ratio, that is the price to dividend ratio, far more important than the price to earning ratio. But the thing is, sometimes what you have learned in the past, you have to give away, right? So if you think, oh, PE about 20 is not going to happen, well, PE can remain about 20 for 20 years of your life. So what do you do then? What do you do? Companies always have to make cash profits and pay dividends before you can invest? Well, airlines like Indigo have established market share, but they don't have profit. So would you have invested? I bought it at 900 rupees. That was again deviation for me, right? So I would be more scared. And you've heard things like better scared than sorry. Only thing is, some changes that I'm making from an older person, say 10,000 years back, you saw an animal which looked like a deer, or it could be a tiger, and you climbed up the tree, and then if it turned out to be a deer, the effort got wasted. To me, that effort is not got wasted. It's okay. Perhaps it made me stronger. Perhaps it taught me that better to be safe than sorry. But today I don't do that. I take partial risk. So if I have 10,000 shares of a company and I think something is wrong, it's going to drop in prices, I go and sell off say 2,000 shares or 3,000 shares, and then if it goes down and I think the fall is temporary, I buy it back. So I will keep trading in my investment position, and I will very rarely invest in my trading position. So that I don't do, but I do this. But am I scared? Of course I'm scared. Am I shit scared? Yes, I am shit scared. But do I think that I will be able to pick up the best management? No. To me, good management, decent management is good enough. It need not meet all the standards. For example, I'm not a great advocate of investing in Tata Group companies. At least I was not till about a year and a half back, and now I find that they've got maybe 2 years back. Now they are concentrating on share price. I don't know who is, I don't know how, but now I'm participating in those rallies. So I'm very happy that I bought Tata Power at 30 rupees or Tata Steel or Tata Motors. Somebody is definitely pushing the shares. Somebody is participating. So is that a risk? Maybe. Maybe it is a risk at a later stage. Maybe it's a risk at a younger stage of any business. Maybe it's a matured business. So now I'm not so scared. I'm not worried that Tata Power will go back to 30 rupees. So I may keep a trailing stop loss at 230, but I'm not really worried too much about the risk in that group, right? So earning per share to me is very important, but a lot of other things are also important. For example, when I've lost money in companies with a very small share capital base, a very low market cap, that is, I've lost money in bad geographies. I've lost money in, say, I don't know, many of you may not have even heard of United Group and all. They were all Hyderabad based. So once bitten, twice shy. I don't mind watching Telugu movies, but Hyderabad companies, no. To me, it is a complete avoid. Do I only look at companies with low debt? Yes, but I also look at companies with more debt if the company is growing fast, the company has enough margins to pay the loan, because these are companies which everybody else avoids. So therefore you get these shares at a good price. But also I would be very happy if it's a Tata Group company with a lot of debt. Like Tata Power to me was attractive even though it had a lot of debt, because you know that somewhere they could step in and they repay the loans in case of push comes to shove, right? So that does not really matter. The question is how much of market share they have. To me, that's very important. It's a question I've always been grappling with, saying, look, if they have market share, one day the ratios will fall in line, and the return on equity, it never matters if the company is making losses, right? So if the company is making losses, ROE, PE, none of those words make any sense. So to me, to that extent, it doesn't really matter. But yes, if it's a running company, if it's 5 years old, 7 years old, 8 years old, if it's a hotel company and it is not making money, I will not buy it just for the prestige. I look for companies on page 3. To me, it's very important that it should not be on page 3. ADAG Group is one such group which I didn't like. Videocon Group I didn't like at all. JP Group I made money, but at some stage I said infrastructure, North India, Delhi based, chances are you will lose money. So JP Group I was out. Modi Group, not too many listed companies now, perhaps I was out. So lot of companies I keep looking at, I keep reading, and I keep exiting, right? So Hero Honda, a good buy for me, because I thought Hero will keep a watch on Honda and Honda will keep a watch on Hero. So but when Honda pulled out, I pulled the plug after a couple of years, maybe a year and a half. I had built my position slowly, and I tapered my position slowly. One of my very good investment strategy business, from an investment strategy, the way I built the position, the way I held, the way I sold, everything. I mean, I must have entered sometime in the 1990s, 94 perhaps, the IPO, and I must have exited in about 2010 or 2012. Full ride I had of that, or was it 1984? I'm not very sure. 84, 94. I'm sorry, but I'm a little confused. So I also like to look at companies with a long runway, long opportunities, and they're looking for better businesses. I also like companies to see, I mean, this is again a survivorship bias, because I have survived for long. I like to see companies if they've survived for long. To me, all these things are important, and to me it's very important that I concentrate on risk. So right now I don't find it a great time to be investing, but I still buy. I keep investing. I keep I keep trading, and I'll do a video on different investors think differently for different purposes. That's it. Thank you.